Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, July 21st, 2021. And our top story today, we're talking about financial wellness, personalized financial guidance, and integrating emergency savings and student loan debt. Well, joining me now to discuss this and a lot more is Janella Frias. She is president of Prudential Retirement. Janella, great to see you. Thanks so much for joining us on the program this morning.
Thank you, Jeff. Great to be here. It's great to speak to you today on such an important and timely topic. You know, we know the retirement crisis started long before the pandemic, but COVID certainly highlighted that many Americans are unprepared for their futures. There are shortcomings in many retirement plans that continue to leave workers vulnerable every time we go through an economic crisis. And let's remember, this is the second crisis in 12 years. And similar to the financial crisis of 2008, it is clear that workers haven't saved enough and they are having to shoulder too much risk during their pre-retirement years. And as an industry leader in the retirement space, we feel that we have the responsibility to the people we serve to prepare them for both today and tomorrow. So we think about financial wellness. We think about meeting the challenges of a changing world through a variety of products and capabilities. And we can talk about that on several fronts today, including legislation, plan design, and education.
Yeah, and so let's talk about legislation. One of the pieces of, that obviously very important, policy is important. We had the Secure Act passed several years ago now, and we're talking about Secure Act 2.0. A provision in the Secure Act allows for the integration of student loan repayment programs integrated with retirement savings programs. Is this something that clients of Prudential and other record keepers are interested in?
Absolutely. I mean, plan sponsors are continually looking for means by which to attract and retain talent, as well as means to improve the overall financial wellness of their workforce. And currently, there are an estimated 45 million student loan borrowers with an average loan amount of about $30,000. So student loan assistance is likely to figure prominently in employment decisions. And student loan obligations also figure prominently in retirement plan participation and savings rates, and can directly impact the overall financial wellness of those employees with student loans, because it is a financial obligation they must meet before they can think about saving for retirement. So these facts have not escaped the attention of employers, which explains why we're seeing growing interest in student loan programs. So we do believe that the enactment of the provisions in the Neil Brady bill and the Card-Portman bill, which permit employers to match contributions on the basis of student loan repayments, will benefit the millions of Americans with student loans and add another valuable tool to increase retirement savings and enhance employee financial wellness.
Thanks for that, Janella. Let's talk about, there's a lot going on, obviously, in the Congress. We're talking about Secure 2.0, but there's a lot of different legislative packages. When you talk to clients of Prudential, people who are in the space, what are clients telling you in terms of what they're looking for from Washington, D.C.?
Yeah, well, in the same vein as student loan programs, there has been a growing recognition on the part of employers of the important role that an emergency savings program can play in the overall financial wellness of employees. The key here is that if an employee is not financially well along the journey towards saving for retirement, they will not be able to save for retirement. And this is where financial wellness and emergency savings come into play. Now, we've all heard the numbers, but they are worth repeating. Nearly 2/3 of Americans, so approximately 63%, have not saved enough outside of their retirement plan to cover a $500 emergency. Now, one study found that for every dollar that a plan participant contributes to their defined contribution plan, they took out 30 to 40 cents to care for an emergency. And this was primarily the case for workers under age 55. And as we know, financial worries do not only impact employees, but they can adversely impact employers through reduced employee engagement and productivity in the workplace. So it is important, and we are hearing a lot from clients about emergency savings. And while Prudential has been working with employers to address the challenges of emergency savings through an after-tax approach related to the employer's retirement plan, we do believe there's more that can and should be done to foster and promote emergency savings programs in the workplace. And in this regard, we are encouraged by the increasing attention emergency savings issues are garnering on Capitol Hill. And of course, again, the pandemic has highlighted this. Most recently, I would note the bipartisan effort on the part of Senators James Lankford and Michael Benefit to further the conversation on emergency savings in the new Congress. So that is quite encouraging for us.
Yeah, we've obviously gone through a very tumultuous time here, and we're talking about financial wellness, I think, in totality here. We've gone through some very difficult times as employers and employees with the pandemic, the financial strife that came as a result of that. Let's talk about what firms like Prudential are doing to help drive positive participant outcomes. And I leave out the word retirement because retirement's important, but as you talked about earlier, we've got student loan debt, we've got debt management, we've got emergency savings. What are firms like Prudential doing to kind of drive better outcomes for participants and employees?
Yeah, Jeff, and that's a great point. And you highlighted it as well. It's not just saving for retirement, it's a much more holistic approach. And as I mentioned earlier, COVID certainly has highlighted that many Americans are unprepared for their futures as well as for the short term whenever they face a financial obstacle. So it is really time for our industry to acknowledge that defined contribution plans were never meant to be the primary vehicle for retirement savings, but now they are. And so we must ask ourselves, are they truly set up to be a retirement plan? And can they really generate that paycheck in retirement that the traditional defined benefit plans generated? So as a starting point, during retirement plan evaluations, we at Prudential work with plan sponsors and advisors to determine if there are three core components in place in the retirement plan. The first is smart plan design. So is a sponsor getting the best bang for their benefit dollars, because obviously they have limited resources. Second is creating an income stream for life. So can that savings vehicle become a payment vehicle and an income stream for life once an individual retires? And third is reinforcing and enabling financial wellness, because again, if an individual is not financially well along the journey, they will not be able to save for retirement. So let's take a minute to focus on that third component of financial wellness. Now, according to our 2020 Plan Sponsor Pulse survey, 76% of plan sponsors said that adding or enhancing financial wellness programs beyond just the traditional saving for retirement is an important objective for their defined contribution plan. So they acknowledge that this is a very important tool. And again, a perfect example of this is the growing interest in emergency savings and student loan assistance, because both of these help employees manage their finances today so that they can save for their futures. And I will say these types of programs are still relatively new in the industry, but we see it really taking some time to gain traction, but we also see interest. In fact, 23% of plan sponsors plan to add an emergency savings vehicle, according to a recent survey. Now, the reality is that we really do need a more holistic approach, and that means incorporating a diverse array of solutions, which include things like managed advice, retirement counseling services, retirement income models, so that individuals understand what their savings actually will convert into in terms of a paycheck, and finally, all other types of financial wellness tools like emergency savings and student loan assistance.
Janelle, let's talk about financial advisors, because historically that group of professionals has provided customized financial advice for individuals. Are FAs still in a really solid position to provide what we're discussing here, which is financial wellness, advice, guidance to help people in a multitude of different areas, not just retirement?
They are, but the reality is that not everyone has access to a traditional financial advisor. Now, the wonderful news is that in this day and age, we have the assistance of technology. So with technology, we can replicate that in-person model in a virtual setting and really making it more available to many more people that really don't have access. So let me first clarify how we service our retirement clients. Our primary education is through our education team, which consists of retirement counselors who provide guidance and are fully licensed, but do not provide fiduciary advice. So this is more about education. But again, it becomes accessible to everyone, every one of the employees of our plan sponsor clients. Now, we recognize that people still need guidance, especially now, and many of them are not very well versed in financial tools and in financial literacy. So we understand that some participants would also prefer to do that in a more personal interaction. So we've actually made it really easy for them. We created the ability for participants to sign up for virtual meetings with our retirement counselors. And the take-up rate on those virtual meetings has been extremely successful and very significant. In 2021 alone, we have seen some incredible results with our virtual one-on-one retirement counselor sessions. And this is for a few reasons. First of all, there's ease of access. Employees like the convenience of being able to meet with us at a time and place of their choosing, as opposed to having to meet with us in an employee break room or a public space on site, as the traditional approach would have it. And we also see a lot of spouses joining the conversation as well, now more than ever, again, because it is virtual and often it is from home. And the other benefit is that employers like the fact that they do not have to schedule formal education sessions as frequently as they did before, because the education is always on, it's always available, and it is easy access. And the interesting fact is that we started our virtual counseling model 3 years ago, before COVID, because of our client demographic and because it just really made a lot of sense. And it was really a natural fit pre-COVID because of that. But once COVID hit, as you can imagine, our team had the ability to transition to full virtual without missing a beat. And it's been a really valuable tool for all our clients and, of course, all our participants as well.
Yeah. Well, Janella, obviously things are moving very quickly from a legislative front and also from a technological front. It's great to see you. Thanks so much for sharing your perspective. And we look forward to having you back on the program again very soon.
Great to see you. See you soon.
Well, thank you, Janella. And when we come back, emergency savings and balancing the need for privacy and data. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking financial wellness this morning, and we're now joined by Peter Welsh. He's Senior Vice President and Head of Retirement Solutions for Millennium Trust Company, and also Kevin Walsh. He's a principal with Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, thanks so much for joining us this morning.
Thank you, Jeffrey.
Thanks. Always great to be on.
Yeah, it's great to talk to you. And Peter, I want to come to you first because, we're talking about financial wellness this morning, and a big part of that is emergency savings, and that's what we're hearing more and more about, emergency savings. What are you hearing from American workers, and how important is this emergency savings component to financial wellness?
Yeah, it's certainly getting more airtime, isn't it, in the last year or so since the pandemic? And as I would say, it's not just an issue for your average American worker, it's also an issue for the employers that they work for. There's the old data that's now getting a little old about the $400 that most employees can't afford for an emergency. But since the 2018 research, a lot more has come up online. Bankrate just did a survey last year that said the average emergency is about $3,500. It's not $400. They also did some research that says the average employee takes about 6 months to recover from one of these emergencies. So the reality is, and I should also say it disproportionately affects females as opposed to males who are inadequately prepared for emergency savings. So the challenge is employees do not leave these concerns. I used to say in the parking lot when they actually went to work, but now maybe in their bedroom in a COVID world, they bring these concerns to work. And there's also a lot of data around if you have financially stressed employees, they have a real problem focusing on the task at hand when they work for you. So I would say it's a very big problem, and I know we'll talk further about additional solutions for it. But clearly, it is a topic of the day, and the time to address it, I think, is certainly now.
Yeah, a really good point, and it also brings in that mental health aspect that's so important when it comes to if you're not set financially, that can have a negative impact on mental health. Kevin, I want to come to you because it's that balancing act between the practical and the law, the legal aspect of this, and you and your colleagues at Groom right on top of the issues related to privacy. What's the balance here with some of the privacy laws that we've seen both at the federal and the local state level?
Yeah, and I think that's a great question. And Jeff, when I think financial wellness is a big deal, and when I think emergency savings is a big deal, and I think at some point your network is going to branch out where you're going to have not just a retirement network, but also an emergency saving network.
I hope so.
But so when we look at financial wellness and we look at it from a privacy standpoint, we've got kind of competing aims here. One is, there's this goal of providing employees with more and providing what they expect. 20 years ago, maybe the only thing you got from your employer was some help with retirement. But now there's an expectation that, retirement is one of your financial goals, but you want to be able to be in a position for emergencies. You'd like to be in a position where, you can pay for things like your kids in college or to buy a home. And so there's this growing awareness that a holistic approach to kind of employees' financial well-being or financial wellness is important. And kind of the countervailing current then is that we've seen kind of big movements on the privacy front as a result of, things like data analytics and Cambridge Analytics in the 2016 election, or, just different fears that, big companies may or may not be using data in a way that folks aren't comfortable with. And the rubber hits the road here with financial wellness because to a degree, in order to provide someone with holistic financial help, or to provide someone with services that might be helpful for them financially in the long run, you need to know a fair amount about those individuals. So in today's environment, employers tend to be in a position where they need to share some information about their employees in order to offer these financial wellness solutions. Looking at the states, we've seen action in California, Virginia, and other states are acting now to enact, kind of comprehensive laws that are regulating privacy. And the message that that my colleagues at Groom and I have been giving to state regulators is, we understand that individuals want to have privacy rights. Totally makes sense to us. But, don't throw the baby out with the bathwater here, which is that, there's things that employees want, there's things that participants want, there's things that individuals like you and me want, where we would like our employers to be in a position to provide us with, the best retirement benefits, best health benefits, and in today's world of uncertainty, the best financial wellness benefits. So we work with different states to make sure that these privacy laws don't, interfere with, conflict with, create problems for providing these beneficial solutions to employees.
Peter, I want to come back to you. Thanks, Kevin, for that. Peter, I want to come back to you because, this is obviously a hot topic in Washington, D.C. I've talked to Kevin and folks at Groom and others about Secure 2.0 savings, but emergency savings is really top of mind. And I know it's top of mind for the industry. When you think about solutions, what can we expect possibly to see both in the near term and in the long term?
By and large, emergency savings are not qualified benefits, right? This is just doing things that maybe your parents or my parents did 40 or 50 years ago, just had a separate side account for this with after-tax dollars. So it's a little difficult right now to think about how DC will provide solutions, although Langford just introduced a bill and would like to get it part of the 2.0, which would allow up to $1,000 to be used for emergencies out of your 401k plan. There's kind of two emergency solutions. One is what we call an in-plan solution. And I think that's where Congress will probably focus because that's where the tax laws and the DOL have oversight. And then you have the out-of-plan. And currently the out-of-plan is just after-tax dollars. So how do we most effectively use those dollars and save those dollars and prepare for emergency? So I think what certainly the Langford bill is going to do and others will focus on in-plan. I would love to see Congress focus on maybe providing some tax incentives for the after-tax account out-of-plan. And that could take any number of forms. I know tax deductions right now are at a premium, but you could potentially provide employer contributions to match or to pre-fund these emergency savings accounts. And maybe we don't withhold the FICA FUTA SUTA taxes. That might be one idea, or provide some other incentive, some tax credits available. But to your point, it has to be addressed. It is impossible, in my opinion, to think longer term for the American worker about retirement in 30 or 40 or 50 years if they can't absorb an emergency that could be right around the corner in the next few weeks. It is absolutely critical that we address the immediate need and then focus on the long term.
Yeah, and Kevin, obviously Peter brings up some really good points. There's a big focus on retirement and retirement security, both in the Congress and the U.S. Senate. Peter mentioned the Langford bill, but others are really stepping up here. How do you see this kind of potentially shaking out? This could be the summer of not only baseball and getting out post-COVID, but also the summer of retirement security and emergency savings security.
It could be. And I think Peter made some great points that highlight some of the tension, why this area is a tough one. Because when we look at the points Peter was making, we want to encourage folks to save for retirement. And if we're going to use the retirement plan then as a vehicle for taking money out for emergencies, then it leaves you with less in retirement. On the other hand, if you don't let people get money out, then they're less inclined to put money away because they've got to save for a rainy day elsewhere, and then contribution rates. And again, they don't get to a retirement. So I think Peter was onto something where he said, maybe a second way to save, either, outside of a plan or a separate vehicle that addresses just emergency saving would be an interesting idea. Looking at the legislation this year, last year we saw a whole bunch of, during COVID, we saw the rules change for people taking hardship distributions, which essentially was allowing for, emergency withdrawals, distributions from retirement plans. Coming out of COVID, it would be surprising to see those rules extended much further. And then I really think we're still at the proposal stage in terms of developing policies and developing a program for addressing this. And I view it as a separate track than retirement savings, although it's just as vital, but this emergency savings solution.
And Peter, in terms of the industry, and you have the benefit of working with a lot of different record keepers that serve the space, and asset managers too, is the industry ready with solutions? Whether it's in plan, out of plan, with data, without data, how's the industry shaping up here?
It is getting ready. Let's just put it that way. The challenge has been to figure out how best to implement such a solution. And I think we we now are consolidating around the workplace. The workplace has shown time and time again that that is the best place to capture dollars, whether that's for your health insurance, whether that's for your retirement, or in the future for your emergency savings. So doing it out of plan, and I can say I've worked for record keepers for 20 years, and I don't have any bias necessarily against these in-plan solutions, but I can tell you record keeping systems for 401k plans were not designed for rapid in and outs, debit card transactions, repayments. They provide for loans oftentimes, but those are singular events. Emergency savings, you've got money coming in and going out, and coalescing around a workplace savings solution and making it look like an employee benefit. So I mentioned earlier, an employer can maybe pre-fund similar to an HSA. They could match similar to a 401k. In my conversations with employers, that feels comfortable. That feels familiar to most of these folks. They're used to looking at their suite of employee benefits and saying, oh yeah, we match or we pre-fund, and this is kind of part of that same dialogue. So there are solutions. Certainly we have one at Millennium Trust at the workplace, but I think you'll see several more in the next few years pop up, because as I said in the last moment, there really isn't an option. We have to help the vast majority of American workers solve this issue.
Yeah, well, certainly this is going to be an important topic. It's bubbling up, for lack of a better term. It's coming up in Congress. It's coming up within the industry. Gentlemen, we're going to have to leave it there. Great to talk to you as always. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Great. Thank you, Jeff.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow, so until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.